This ad-free podcast is part of your Slate Plus membership.
Hello! Welcome to Slate Money, your guide to the business and finance news of the week. I'm Felix Salmon of Axios with financial advice columnist Elizabeth Spires.
Hello.
With Emily Peck of Axios.
Hello, hello.
We are going to talk about the U.S. economy and why it's doing so well. And Emily has an astonishing 5-part list, which explains everything. This is all you need to listen to understand the world. We are going to talk about Universal Music Group and their fight with TikTok. We are going to talk about Lyft and its earnings typo. We have a Slate Plus segment about chocolate chip ice cream, which is revelatory. It's all coming up on Slate Money.
Hey there, Slate Money listeners. Before we start the show, I want to let you know about a story coming up a little later. It's from one of our partners, SAP. AI comes at you fast. If you don't get reliable and relevant advice, your business might miss out. Whether you're looking to automate tasks or embed AI in your business processes, SAP can help. To learn more, head to sap.com/AI and stick around for expert advice on how to embrace AI with confidence. Reboot your credit card with Apple Card. It gives you unlimited daily cash back that can automatically grow over time when you open a savings account. A high-yield, low-effort way to grow your money with no fees. Apply for Apple Card in the Wallet app on iPhone to start earning daily cash and growing it with savings today. Apple Card subject to credit approval. Savings available to Apple Card owners subject to eligibility. Apple Card and Savings by Goldman Sachs Bank USA, Salt Lake City branch. Member FDIC. Terms apply.
Okay, so Emily, I want to take this whole really boring discourse of the vibe session and like why are Americans unhappy when the economy is good. We are not going to have that conversation because it's boring as all hell at this point and we've had it a million times. But I want to have a related conversation, which is why is America so healthy, economically speaking, when all of the other countries in the developed world aren't? We have two major economies that are actually in recession now. Japan and the UK both had negative GDP prints for both the third quarter and the fourth quarter of 2023. And if you look across, Europe and the rich world generally, no one seems to be doing that well. And so my question for you is is this just amazing American exceptionalism? Is America just special?
Well, first of all, I want to say USA, USA, USA. Okay, got that out of the way. Now I have 5 reasons for you, okay? Number 1, we had a lot of stimulus money that we spent during the COVID recession. The other wealthy nations don't compare. I think we spent $5 trillion. That money went to the people, the peeps, and the businesses, and that money got spent and saved and invested, and it was a big deal.
The economic stimulus actually did its job, and it stimulated the economy.
Yes.
And just to be very clear about this, it's really weird but true that America was much better at doing economic stimulus than anywhere in Europe. Europe has this reputation for being this sort of tax and spend utopia, but in fact, there are lots of constraints on what governments can do there, partly because of the fact that they all have to share a currency. And so the amount of economic stimulus and fiscal stimulus that you saw in the EU is really small by comparison. So that's a good one. I like that one.
All right. Rolling on, number 2. At number 2, we have energy. The U.S. is an energy exporter. And that came in handy when there was a big war that started 2 years ago when Russia invaded Ukraine and energy prices shot up astronomically. And that really, really hurt the other wealthy nations, especially those European ones that import energy. And that really, really hit those economies hard. And yes, gas prices went up a lot. My oil bill went up a lot. All of that is true, but we were relatively insulated in comparison.
Especially vis-a-vis the UK, where energy prices have skyrocketed.
Right, and the UK used to be an energy exporter and isn't anymore. And yeah, if you produce your own energy, then you're more or less insulated. Now, it is true that energy is fungible. You know, there is a sort of global price of oil, and if you can sell it for more in Europe, you will. So higher energy prices in one country basically are always reflected by higher energy prices everywhere. But to Emily's point, if you're an exporter, you're just making lots of money and you're going, hey, we're pumping all of this oil and gas and we're selling it around the world and we're selling it domestically and we're happy. If you're an importer, you just have much less control and you just wind up sending that money to the exporters like America.
Yes.
Number 3.
Number 3, immigration. We have it. I know it's controversial. I know that our leaders don't know how to deal with it, but at the end of the day, we have immigrants coming here, especially after, lockdown ended. And those workers have really helped keep the economy booming. I think Chair Powell spoke about immigration in the labor market recently.
The CBO just came out and said that GDP is going to be $7 trillion bigger thanks to the unexpectedly high amount of immigration.
You would think between that and the pronatalists, the conservatives would be very happy about this, but no.
Well, I mean, yeah, I think the discourse around immigration is messy as fuck, and it has been completely dominated by the discourse about the southern border, which is related, but is not by any means the full immigration story. There's been a lot of good old-fashioned legal immigration into the United States, which has just done wonders for the economy. And when you have a super tight labor market like we do, you need all the help you can get, basically. And the immigration is just feeding straight through into increased economic output.
And you can make a comparison to Japan, which economy it has shrunk. And one of their key problems is they have a shrinking population and very low immigration. And the US, our population isn't exactly going gangbusters either, but immigration helps with that and offsets also our aging population. And it's really important for the economy and for the labor market.
Although, to be clear, the domestic birth rate in the United States, like if you are an American woman, like how many children you expect to have in your lifetime, is way higher than it is in virtually any European country or Japan. So, even if it's dropped below replacement rate, the domestic population and just giving birth to new babies situation is, comparatively speaking, much stronger in the United States. And the United States is a much younger country than most of Europe, and certainly much younger than Japan.
Yeah.
Okay, number 4.
In at number 4, and this will be politically controversial, I guess, is the Biden administration's signature legislation, the Infrastructure Act, the Inflation Reduction Act, and the CHIPS Act.
I feel like the Inflation Reduction Act was generally accepted to be fiscal stimulus. That was kind of how we managed to get it through.
Okay, well, you can argue about that one. But the other two have spurred construction, manufacturing. They've spurred development of, green economy stuff. There's a lot of building going on that wouldn't otherwise be built and a lot of innovating going on that wouldn't otherwise have been innovative. We can argue more about this one. It's not as clear, but the Biden administration would certainly tell you this is part of the story.
And so if that's true, and I'm kind of with you that it's really hard to tell, that will have shown up in economic growth with astonishing speed. Normally, something like the CHIPS Act is passed on a sort of 10, 15-year time horizon. Like, we want to become big in computer chips and start competing with Taiwan again over the next 2 decades. And now we're like, well, actually it's showing up in Q4 economic growth.
Well, I mean, one place you can see it, and I've written about a little bit, is in the construction of new manufacturing.
Factories. We are building factories. And again, that is not something you're seeing in Japan.
Right. So that's number 4.
5. The best till last.
Number 5. Labor churn, babies. In the European countries, when COVID first hit and everyone was going to lose their jobs, and I think we talked about this on the podcast, in many of the European countries, they pulled policy levers so people didn't lose their jobs. They stayed attached to their employers. In the US, you know how we are. So all the employers just fired everybody. We had unemployment, was it 25% or something? Everyone lost their jobs. And there was this amazing, what happened subsequently is this amazing labor churn. People got better jobs. Everyone kind of shifted, there was the great resignation. There was a great reshuffle. And a lot of people wound up with higher paying better jobs. And that turns out to be a really good thing for the economy. And, at the time I thought it was horrendous, but now it seems like kind of worked out.
I feel like we're skimming over my amazing insight in the Phoenix economy far too quickly here. The point being that the European welfare state was very good at, and is very good at, protecting people's jobs. So if you have a big shock like COVID, then the government basically gives money to employers to keep their employees on payroll. And so, yeah, you didn't have the massive spike in unemployment. Everyone stayed in the old jobs that they had pre-pandemic. And the big great reshuffle where people moved careers, moved physically across the country, and just took advantage of the pandemic to quit their miserable old lives and build something brand new, much more YOLO, didn't really happen. And that is really a key part of why the US is doing very well. And I kind of feel like one of the weaknesses in my book, maybe I didn't go into too much detail on the difference between the US and Europe on this one. That, like, I was like, this is a great Phoenix economy story. We're rising from the ashes stronger than we ever were before. But I didn't talk that much about the degree to which that was a phenomenon that just didn't happen in a lot of the rest of the rich world.
And just to add, the Great Reshuffle is really intertwined with the first thing I talked about, that stimulus, because it's easier to reshuffle if you've got a stimulus check or two or three, or, your monthly childcare check. Like, if you have that security, the enhanced unemployment, all of that, they really came together, intertwined, to support people to make those kinds of changes.
And can we just shout out to the two things which were super key here? Number one was the student loan repayment moratorium. And number two, which is even more important, was the eviction moratorium. And this was again, this is something that is wild to me, with hindsight, is that it was the Centers for Disease Control. It was the CDC who said that for medical reasons, for public health reasons, we needed an eviction moratorium in this country.
It is. I mean, there are a lot of policymakers, though, who argue that housing is a healthcare issue as well.
No, it clearly is. I mean, it was a 100% legitimate healthcare, public health intervention. You do not want people losing their housing and being thrown out onto the street in the middle of a pandemic. That is a terrible idea. And what the CDC did was exactly the right thing to do. But the point is that if you know that you are safe in your home, then you can take certain risks that you couldn't otherwise take in terms of quitting your job and trying to do something else.
Yeah, it was really a perfect storm. What's sad is I feel like it's kind of similar if you go back to, the New Deal, all the stimulus back then. But people really liked all that stuff, or maybe they didn't. I don't know exactly. Some people did. It seemed like that had a legacy and that had legs. But the politics around all the stimulus that got done has changed so much. And if something like this happens, a big shock like this again, I just wonder if we would ever respond in the same way. Even the stimulus started in the Trump administration.
Yeah, this is
right?
again. This is a chapter I have in my book called the Armies of the Public Fisc. Right, that Steve Mnuchin is the great unsung hero of the
right.
of the pandemic, and he managed to push through this astonishing fiscal stimulus and the eviction moratorium and all the rest of it. And now you look at the Republicans in Congress, and you're like, there is no way. There is no way they would be okay with that kind of thing. And so, we won the last war, and we know how to win the war, but it is absolutely possible that the, elected Republicans will unilaterally disarm us come the next one.
And just the Democrats too. I feel like they got so much political pushback for a lot of this stuff. The last stimulus under Biden, it was widely criticized for, driving inflation up.
Yeah, and that's the problem. The dominant narrative was that the inflation was fully a function of the stimulus, and it was multifactorial in many ways. But even among, centrist Democrats, if you just ask people, especially if they're kind of middle class, what caused inflation to a person, they will point to the stimulus.
Which is fine. That is a trade-off I will make every day and twice on Sundays. If you ask me, would you rather have a European economic stagnation or American-style economic growth with inflation, I will choose the economic growth with inflation every time, especially given that inflation is even higher in Europe.
Yes. I did want to mention, what are the headwinds upcoming for the U.S. economy? Well, one, I think, is that, Trump gets elected and that's a headwind. But then as I was preparing for this and coming up with my 5, I was kind of like, the stimulus, the number one reason was under Trump. So maybe it'll be fine.
Yeah, if you look at the markets and if you listen to the sort of Davos consensus, it's that no one is too worried about Trump being president on an economic level. I remember vividly in 2016, Justin Wolfers coming out and saying on the eve of the election that if Trump got elected, the stock market would fall by 20% and we'd have a massive market crash. And he got elected and the market went up rather than down. And it just kept on going up. And the great sort of economic fear of Trump turned out to be misplaced. And as I say, when we hit this unexpected emergency in the form of COVID, Steve Mnuchin, his Treasury Secretary, really came through and did some really good stuff. And it is certain that a second Trump term will be significantly different from the first Trump term, and he probably won't have the more sort of mainstream centrist technocrats like Mnuchin and Gary Cohn that he had in the first term. But I have yet to find someone who's genuinely, saying that another Trump term would be terrible for GDP growth.
Well, that's partly a function of a carryover or dynamic where negative partisanship is so high now that Republicans obstruct anything that Democrats try to do that's positive for the economy. And if there is a Republican in office, they'll stop doing that.
And yet somehow, the economy seems to be doing just fine. Let's move on to TikTok, eh?
If you don't want to hear ads right now and want to have access to a bunch of great Slate stuff, sign up for Slate Plus. With Slate Plus, you get ad-free listening on all Slate accounts, plus unlimited access to all Slate.com content and our members-only newsletter, and an exclusive bonus segment at the end of this episode. And this one you do not want to miss today, unless maybe you're trying to eat healthy. But you should still listen to it because it's about ice cream and chocolate chip ice cream. We reveal our favorite flavors and talk about a lot of ice cream stuff.
So when I'm traveling, my financial health hack is to spend money. And specifically in Europe, spend a little bit extra money to travel first class on the trains. European first class train travel is amazing. And no one in Europe seems to feel the need to upgrade. So you get huge amounts of space and a much better service or significantly better service. And the amount you pay on an absolute level is really quite small. It's way, way smaller than upgrading on a plane would be. So I feel like treating yourself to relatively cheap luxuries that feel just super luxurious is a smart financial hack and travel hack.
Reboot your credit card with Apple Card. It gives you unlimited daily cash back that can automatically grow over time when you open a savings account. A high-yield, low-effort way to grow your money with no fees. Apply for Apple Card in the Wallet app on iPhone to start earning daily cash and growing it with savings today. Apple Card subject to credit approval. Savings available to Apple Card owners subject to eligibility. Apple Card and Savings by Goldman Sachs Bank USA, Salt Lake City branch. Member FDIC. Terms apply.
Okay, so Elizabeth.
Yes,
You're on TikTok, right?
I am, but I don't post very much.
You don't post. But
No.
This is also one of the great things about TikTok is it's not really one of those social networks like, Facebook, where everyone is constantly telling everyone else what they're up to. It is one of those networks where 1% of the user base produces 99% of the content. And before it was TikTok, it was an app called Musical.ly. And TikTok, when ByteDance bought Musical.ly and rebranded it as TikTok. And Musical.ly was basically what it says on the tin. It was a thing where you could take a piece of music and dance to it and mime to it. And it really took off. And it's always been based on music. And now it is in this massive fight with the biggest record label in the world, Universal Music Group, because Universal is saying, you're using all of our music. You're making an absolute fuck ton of money. So pay us just like every other streamer pays us. Spotify pays us, YouTube pays us, Instagram pays us. Every time anyone uses our music, you need to pay us too. And TikTok is like, can we give you almost nothing? And Universal is like, no, you cannot give us almost nothing. So now there is a standoff, and no UMG music can be used on TikTok.
I'm a little pro TikTok here, though, because the TikTok has been responsible for so much new music discovery, and large music publishers really need that. And so if you completely cut off TikTok, it's they're going back to an older model where that doesn't necessarily work. And when you consider that there was a stat that 67% of users are more likely to seek out new music after having heard it on TikTok.
Right. But if you think about the new music discovery mechanisms, whether it's Spotify, whether it's the radio or whatever, all of those new music discovery mechanisms have historically always paid royalties to the record labels. Just because you're using a streaming service to discover music doesn't mean that that's a reason for that service not to pay royalties.
Yeah, I'm not sure the artists, though, believe that TikTok, the rates they're asking for are somehow more damaging than what Spotify does.
Spotify isn't damaging.
Well, I mean, in terms of not paying them rates that they believe they should be paid. There was a comment from Jack Antonoff who said he was pissed off that, UMG did this without really talking to the artists. And the artists who don't really need this are people like Jack Antonoff, who are not going to live and die on TikTok. But they don't really buy UMG's logic.
I think he buys the logic. He wanted to be more in the room and consulted, but I think he buys the logic. I think artists want to be paid. Don't you think that, Emily?
Yeah, I think, what UMG is doing here is just playing hardball. And apparently they get less money, or TikTok pays lower rates than the other platforms, and they want more money. And even though TikTok is only 1% of UMG's revenue, they want that number to go up. And I think unsaid or less discussed is the AI angle here, because one of UMG's demand is just tougher restrictions and monitoring around AI features, because that's the latest existential threat to everyone who makes stuff right now is AI. And we saw last year there was that AI generated Drake and Weeknd song that caused a lot of chaos and upset, and sort of woke up a lot of people to the fact that AI could be maybe a new threat or challenge for the industry. So one of the big asks from Universal Music Group is let's make sure that there are protections against this. Let's make sure if our artist music gets used in something AI generated that, we get credit for it or we're paid for it, et cetera, et cetera. I think that's a really important part of this.
Exactly. AI is going out there being trained on a whole corpus of UMG music, and UMG wants to make money off that. There's a really good profile by John Seabrook in The New Yorker, which I can recommend, where on the one hand, it's clearly a threat, but on the other hand, it's also clearly an amazing opportunity. And all of this AI gives music producers the ability to just be their most creative and most best selves and just be much more productive and make much better stuff. And UMG is excited about that, but they just want to be doing it themselves. They don't want to outsource that ability to random people on TikTok. And so that's part of it. But the core of it is really this question of, is TikTok broadcasting music to the masses and therefore needing to pay a license? Or is it free advertising for artists, and the labels should just be grateful that they're on TikTok at all? And I think the answer there is it's advertising, but there's no particular reason why the advertiser using the music should be getting the music for free. And and that we see this, it reminds me so much of every so often some cable company will lose Disney programming because there's a big fight about how much Disney wants to be paid by the cable company. And and eventually they come to an agreement. I feel like it's one of those. TikTok has just been so used to getting music for almost nothing for most of its existence that it's struggling to come around to the idea that it actually has to pay for it. But it's clearly so core to the TikTok value proposition in terms of TikTok's own audience that, of course they should pay.
And you could see how important it is because UMG pulled all its music. And now, I mean, every story about this has, shares TikToks from a bunch of creators who are like whining about how they don't have the music in their videos right now, getting on their knees or like having to sing Taylor Swift songs like themselves. Oof.
The creators have always, just to be clear about this, the creators have always on TikTok had the ability to make videos using someone else's music for free. They have never needed to pay any money to the people whose music they are using. And that is an amazing innovation that we now have with social media and with TikTok, is that we have the ability to allow people to effectively like remix music and use it in interesting new ways that the original artists might never have intended, and upload it to TikTok and see it go viral and see it make the song popular. And all of that at zero cost to the creator. And the reason you can do that at zero cost to the creator is because behind the scenes, TikTok is monetizing it by selling ads, and then TikTok can use some of that ad money to pay the music label. That seems to be the sensible way to do it, no, Elizabeth?
Well, no, I would say there are two things at play here. One is that I wouldn't discount the value of TikTok for artists, especially if they're not, top 10 big names. I think it's very important for them to be on TikTok. They've all been told by their labels that they have to be on TikTok. And a lot of them have invested, a lot of time and effort into doing that. Another thing is that most of TikTok's base is not, professional creators. It's people who would do the same thing if they were uploading a family video of their kids dancing a, whoever onto Facebook. Nobody thinks about that as a scenario where you're ripping off artists.
No, because Facebook pays money for that.
Well, TikTok does too. What they're asking for is a discount.
No, it doesn't. It pays almost nothing.
Aren't they paying $100 million a year? And then by comparison, Meta's paying like 200,
twice as much.
So it's not nothing. They're asking for a lower rate. Like they're not asking for nothing.
No, they're paying almost nothing because the amount of music, like YouTube is the comparison here, not Meta. YouTube pays billions and billions of dollars to music labels because that music is the core of what is being consumed. And TikTok is similarly just a network based on music. Music is at the heart of TikTok. And that's why it's used as a discovery mechanism. And that's why it's so important to record labels. And I 100% agree with you that it is important to artists. And I'm not saying that artists shouldn't be on TikTok. And I'm not saying that music shouldn't be on TikTok. Music should be on TikTok. It should just be paid for.
But there's also another factor here. If you're going to compare YouTube to TikTok, TikTok is very short format. There are a lot of ways to use music in TikTok that would be justifiable under fair use law. But when you see people putting entire songs on YouTube, which is longer format, and there's a lot of music that's just on YouTube with literally like a blank screen and whatever the music is. And you don't see that on TikTok. So I think there is a difference.
Yeah, I agree that it's a different use case. But I also think that if you look at the, ByteDance is worth what? $75 billion or something. If they're paying $100 million a year for music rights, and music is at the heart of everything they do, that just, there's a disconnect there.
Yeah, UMG should play hardball. I mean, I know these creators don't like it. And yes, some of the big artists have complained, but I mean, at the end of the day, if everyone's making more money, and it seems like that's fine. And if there's these AI protections get passed, UMG is the biggest music publisher, recording company. And so what it does is going to be, they're going to be a leader, what everyone else will wind up doing too. So I feel like it's important to get this right.
Yeah, I think that's the really important thing here, is that this is not just a fight between UMG and TikTok. That all the other major record labels all have what's known as MFN clauses, most favored. Basically, what it means is that if TikTok and Universal come to an agreement, then automatically under the existing contracts that the other record labels have, TikTok will be paying all of the other record labels more as well, because the idea is that they have a disagreement that the other record labels aren't going to get paid less than Universal is. So this will be a much bigger thing than just the Universal artists. Everyone will get paid more. They'll get paid more out of the ad revenue that is going to TikTok. And that means that TikTok will make slightly less profit and the artists will end up making more. So I'm happy with that.
Well, I also have a quick question about the AI stuff. One thing that I don't understand is how TikTok would be able to police AI if they negotiated some kind of broad agreement with UMG. Most of the people who are going after platforms for AI stuff, they're not going directly after Facebook or Twitter or whatever. They're going after OpenAI or these, companies that do generative AI. And I'm not sure how, if we're talking about broad rules, how would TikTok ensure that they can keep AI generated stuff off the platform?
The question is basically what happens when someone uploads a video with music that is not coming from any kind of a record label that's just been generated by an AI. And the answer is that the whole technology behind payments is that whenever anyone uploads a video with music, it's very easy to just effectively like Shazam that music. You can see exactly what that music is. You can identify it very easily. You can work out what record label it comes from, and then you can pay the royalties to that record label rather than to some other record label, right? We already have, and TikTok has been for years, using technology which identifies music and identifies which label it comes from. So the corollary of that is that if someone uploads AI music that does not come from any record label, then it is very easy to identify that as, wait, this is not legitimate music. This is not coming from any record label. It is very easy to identify it as AI and say, no, I'm sorry, you can't upload that because what you've done there is you've uploaded a kind of music that we aren't cool with.
Well, not if I'm a musician and I write my own stuff and I play it on YouTube or whatever, or TikTok. Like, that's not sourced to anything.
Exactly. So the only thing you need is like a small little carve out for stuff that people are genuinely creating themselves and haven't uploaded through any kind of like rights management. Like nowadays, it's super interesting. 10 years ago, 90% of the songs uploaded to rights management platforms came from big record labels. Now it's like 10%. Now everyone in their basement is just, creating new stuff and uploading it with all the correct rights and stuff through these rights management platforms. And they generally do that before they upload the TikTok. That's the whole point, right? That's because everyone is trying to use TikTok as a way for people to discover their music. They want that music to be up there, logged and indexed before they upload the video. And so that bit, like once it's up there and logged and everything, then TikTok is in the clear, right? Then TikTok can start paying them royalties for what they did. And if Universal has their own beef with that creator saying, wait, you used AI that you trained on Universal artists, that music is not kosher for some reason, then Universal can take it up with the creator. Like TikTok is not liable at that point. Okay, but let's move on to typos, shall we?
This podcast is brought to you by Slate Studios and SAP. AI is moving so fast. If you don't get reliable and relevant advice, your business might miss out. Welcome to Dear Artie, an advice column from SAP, where we tackle the tricky questions at the intersection of AI and business. Let's meet our expert.
Hi, I'm Ian Khan. I'm a technology futurist, speaker, and author, and I love to help organizations measure their current state of readiness for an AI-driven world. I'm excited to dive into today's question.
Dear Artie, our finance team is top-notch, but small. How can AI support them? Signed, Financially Drained.
Well, financially drained, a lot is happening in finance and AI, and the possibilities are endless. First of all, AI can help your finance team analyze massive amounts of financial data faster than any human or a team of people could do. Second, it can help perform functions on data through algorithms. This can connect different systems together and really simplify decision-making for your finance team. And last but not least, AI can help reduce the time needed for data to provide insights so that your leaders can make faster decisions.
Embrace AI with confidence. Head to sap.com/AI to learn more.
Slate Money is sponsored this week by Hims. You probably have a checklist of things you need to have before you go out: your phone, your wallet, your keys. How does your hair look? Is my hair even there? If your hair is thinning, you might not be so confident even leaving the house in the first place. And that is why you need to check out Hims. Hims is changing men's healthcare by providing simple and convenient access to science-backed treatments for erectile dysfunction, hair loss, weight loss, you name it. The entire process is 100% online, so you can improve your health fast with an array of high-quality options, including pills or chews for ED and serums, sprays, or oral options for hair loss. Once it's prescribed to you, your medication ships directly to you for free in discreet packaging, no waiting rooms, no pharmacy visits, no insurance needed. Pay one low price for your treatments, online visits, ongoing shipments, everything. Start your free online visit today at hims.com/money. That's HIMS.com/money for your personalized treatment options. hims.com/money. Prescriptions require an online consultation with a healthcare provider who will determine if appropriate. Restrictions apply. See hims.com/money for details and important safety information. Subscription required. Price varies based on product and subscription plan. Slate Money is sponsored this week by Progressive Insurance. Right now you're listening to this podcast, but you're probably also driving or cleaning or exercising or grocery shopping. In any case, whatever you're doing, so long as you're not behind the wheel of a moving vehicle, you could be getting an auto quote from Progressive Insurance. It's easy, and you could save money by doing it right from your phone. Drivers who save by switching to Progressive save nearly $750 on average, and auto customers qualify for an average of 7 discounts. Discounts for having multiple vehicles on your policy, being a homeowner, and more. Progressive will be with you 24/7, 365 days a year. You'll be protected no matter what. Multitask right now. Quote your car insurance at progressive.com to join the over 28 million drivers who trust Progressive. Progressive Casualty Insurance Company and affiliates. National average 12-month savings of $744 by new customers surveyed who saved with Progressive between June 2022 and May 2023. Potential savings will vary. Discounts not available in all states and situations. Emily, tell me about Lyft's astonishing typo.
Lyft, had earnings release earlier this week, and in its release, it said one of its profit margins measures was going to expand by 500 basis points or 5 percentage points this year. But actually, it was only 50 basis points, which is 0.5 percentage points, which is a lot less. But at first, when people believed the 500 basis points thingy, the stock soared. And then, ultimately they said, whoopsies, it was a typo. We're so sorry. The CEO came out and said, this is on me. And everyone had a great old time memeing and laughing about this on Twitter.
It was a big mistake, right? The old, it was called like adjusted EBITDA margin, basically, like the inherent profitability of the company.
Yes.
Was 1.6%. And they were like, that's going up by 500 basis points. And everyone's like, wait, it's going up from 1.6% to 6.6%? That is a huge increase. And so they bid up the stock. I think it rose like 67% or something. Mm-hmm. But the point is, this was all in the earnings that came out at 4:30, 30 minutes after the market closed. And the whole point of releasing earnings after the market closes is that, you have some time. You have all the way until 9:30 the following morning for people to work out what is going on and try and work out what the new correct price of the stock should be, right? So in theory, if there's a typo in the press release and it's caught within an hour, which it was, or certainly within an hour and a half, then no harm, no foul. You're like, oh, wait, there's a typo, fix the typo. Certainly by 9:30 in the morning when the market opens, everyone will understand that there's a typo. They will have listened to the call where the CFO was like, no, we fucked up on the press release. We got it wrong. It's 50, it's not 500. And no harm, no foul. So all of this is fine in theory, but then you run into this thing in practice, which is after hours trading. So what the fuck is up with that?
Different kind of trader. Those are not the people who are looking at, longer term horizons for Lyft. They're people who get excited by a tiny development in
Aren't they just robots? Isn't it just algorithms or?
It's algorithms who are listening to the earnings call and listening to the CFO say, whoops, I meant 50, not 500, and then immediately selling. So they're very sophisticated robots if they're robots.
No, but a lot of it is automated trades, and they see the numbers reported are seen, I think, and then trades are made.
There are also just people who trade into volatility. And so once it starts, there's a kind of momentum thing that happens.
But my question is at a deeper level here, which is the stock market is open from 9:30 to 4. We all understand that's the trading day. Stocks trade between 9:30 and 4. Why are they trading at like 5 o'clock, 6 o'clock, 7 o'clock in the evening? I understand that, like, as you say, the robots and the volatility junkies love it. Like, generally in after hours trading, the bid offer spread is wider, so there's more opportunity to go in and do high frequency trading and make more money. The question I have, which I have, again, like, a theory about this, but the deep question I have is, so, like, why is it allowed to exist? Why is the SEC okay with this? Because the SEC's job is to protect investors, right? And it's pretty clear if you look at what happened to the Lyft share price in after-hours trading, there's a lot of danger in there and people aren't being protected. Like, I think the SEC should be more aggressive in terms of saying, I'm sorry, but 9:30 to 4 is enough. You don't need to trade more than that. And so so we're just going to force you to trade only between 9:30 and 4. In theory, the reason it exists is because it hasn't been banned, right? The reason it exists is because I own a stock, I want to sell it, you want to buy it. We are two free Americans and we can make our own bargains between us and agree to trade that stock between us at any time of the night or the weekend or anytime we like, right? You and I can make a deal on a Saturday afternoon where I'm like, okay, I will sell you my Disney stock for $12 a share. And then that's, and we can draw up a contract and can be legally binding and we can do that. So I think the real reason for this is just like, it's legally difficult for the SEC to ban that kind of activity. And so, these after hours exchanges have cropped up where people are like, look, you guys want to trade after hours, it's less liquid, it's more dangerous, it's more risky, but if you want to do it, who are we to stop you? And then people are like, oh, awesome, we get to trade the earnings release as it comes out and play these crazy games. And the SEC is like, okay, whatever. The SEC is ultimately just saying, like, if you guys want to do this dumb, foolish thing, just go ahead, knock yourself out, lose a bunch of money, whatever, like, just do it. Okay. They just don't care enough.
And it does turn out this is a story that has a happy ending for Lyft, which we should note has misspelled its name. And so...
Yeah, if you're going to spell Lyft with a Y, then, like, at that point, all bets are off. Just don't trust anything in the press release.
Exactly. But anyway, by Wednesday, the day after the typo, the stock, it turned out the earnings report, though the profit margins weren't as insane as they initially said, Lyft's earnings report was pretty good. And it wound up that the stock rose 35%. I haven't looked at it as we're taping on Friday, but the stock is up and investors are happy with the company. So it's kind of like a fairy tale, basically.
Still, it would have risen just as much without the after hours trading.
Yeah. So some people made and lost money after hours.
Yeah. Like I am not crying any tears for the people who made and lost money in after hours trading. All of those people walked in with their eyes open. And I think that's ultimately the reason why the SEC isn't cracking down on it, right? They're like, on the one hand, our job is investor protection. And so we have created this clean, well-lighted space between the hours of 9:30 and 4 where you investors are protected. And then if you want to go off and like trade stocks in a back alley somewhere on at 7 o'clock at night, that's on you. Don't blame us if you get your face ripped off. Let's have a numbers round. Elizabeth, do you have a number?
Yep. My number is 20, and that's percent. And that's 20% more people die in January than March. So
what?
The month you're most likely to die in is January, and the day that it is the deadliest, according to CDC data going back to 1999, is January 1st. And there is a
those
reason
New Year's
for
Eve
Why?
parties will literally kill you.
What's happening?
So the reason for it is that mostly if you're middle-aged or over, you're a little bit less capable of handling environmental changes. So there are higher rates of death from heart disease and respiratory illnesses, particularly.
And wait, why do environmental changes happen on the 1st of January?
They're more like winter diseases. So it's also higher in December. It's higher in months where you have extremely cold weather. And partly because if you have heart problems, your blood vessels constrict, and that can affect problems if you have some existing condition. And then the respiratory stuff, as we all know, increases in the winter no matter what.
And then if you've survived all the way until March, at that point you're fine and you're unlikely to.
Yes, you're least likely to die in July, according to the chart that I saw.
Is this January thing? Remember a few years ago, the wealth tax rules were changing and a bunch of these like old rich people were like desperately hanging on they were trying to die early in December.
There was like one year. I remember Paul Krugman called it like the throw grandma from the train act or something. There was one year where if you died with like literally any amount of money, your heirs would pay no inheritance tax. And so everyone was like, Grandma, please stay alive until January the 1st so that like, at that point we don't need to pay inheritance tax. And then towards the end of the year, everyone was like, can you please die by December the 31st? Because otherwise we're going to have to pay inheritance tax.
Yeah. Is this like a tax thing? Or like people trying to make it to the new year? They're like, if I make it to this thing, I'll have like 100 years under my belt or something. Is there a psychological situation?
I'm sure there is. My number is 8.5%, which is what UBS reckons that a bond investor, your typical bond investor in like, investment grade bonds, is going to return in 2024, which is kind of really interesting on a bunch of different levels. On the one hand, as we know, bonds are yielding quite a lot right now because of the Fed. And so you have like a base yield above 5% for these bonds. And then everyone expects the Fed to start cutting rates this year. And so if the Fed cuts rates, then yields are going to go down, prices are going to go up. And so between the high yields and the price improvement, total return, they reckon, is going to be about 8.5%. And that's a really low risk investment. Like if you buy bonds right now, the chances of you losing money this year on that investment is minuscule because, they're investment grade bonds, so they're not going to default, and yields are not particularly likely to go up from current levels. And you're already getting a nice healthy yield on the bonds that you're buying, so it's paying the coupon. So what I'm saying here is that the kind of safe and boring, if you want to be really, really safe and boring, you can get 8.5% right now on your investments. And that's got to be somewhere near an all-time high. And so that gives you an idea of just how amazing it is that the stock market has been going up and hitting all of these new highs, because the return you need on stocks obviously needs to be higher than 8.5% to make it worth investing in stocks rather than bonds.
Well, Felix.
Yes.
It almost sounds like you're giving listeners financial advice.
But I would never do that. No. Take no financial advice from me. Are you going to do a Charlotte Coles number?
I will not allow that to happen. He cannot front run my number. My number is 50,000. That is the amount that New York Magazine writer Charlotte Coles put in a shoebox. And
in dollars, in cash.
In dollars, in cash. Put in a shoebox and handed someone from the back of a Mercedes in front of her New York City home after she was scammed. And she wrote about it for The Cut in New York Magazine. And Charlotte Coles, it turns out, is their financial advice columnist. Now, it's hard you can't make it up. You can't make it up. She was scammed. It was an elaborate one. She was called up, something Amazon, something fake. We know that you're the last 4 digits of your social security number. We know your kid's name, something. This is very secret. The FTC is involved. The FBI is involved. And she fell for it. And you can read all about it on New York Magazine. And I really wanted to talk about it, but it kind of came out too late after we had planned out the episode. But I wanted to ask Elizabeth.
Yeah, as our in-house financial advice columnist, if you fell for this scam, would you ever admit it in public? And number 2, if you did admit it in public, would you ever produce another financial advice column again?
Probably not. But then this would never happen to me because I just don't have $50K sitting around in cash.
You'd be like, here's my $10.
Apparently she like inherited it from her grandfather. Like this was her literally her inheritance.
She says in the piece, she says some of it's inheritance, some of it's saved up, blah, blah, blah. Yeah. She tries to keep a lot of money saved. So, I mean, on the one hand, that would indicate this is a good person to take financial advice from. Someone who can have that much saved up, that's good. Although we can argue too much in cash should have been some investments. Why was it just sitting in cash? But it's a good time to sit in cash. So who knows? That's a whole other conversation. But the key question is, Elizabeth, would you ever admit to being scammed in this way as a person who people turn to for financial advice in Slate's Pay Dirt column?
Not publicly, I don't think. I think I would tell my friends about it, and my family to make sure they didn't get scammed. And it's worth noting that the scam seemed to be kind of elaborate. Like she asked the supposed FBI people for their badge numbers and, documentation, and called the number they gave her that was spoofing like an FBI number.
She didn't call the number. That's the crazy thing. They were like, look up the number for the FBI and I will call you from that number. Like, it's so easy to spoof a number that you're calling from. All she needed to do was try and call them back on that number and she would have realized it was all a scam.
I feel like sometimes you can just get into some weird loop where you can be scammed. Like you can just something gets activated in your brain. And then once it is, you just make bad decisions. I feel like it could maybe happen to anyone. I mean, a lot of people, on the social media networks were like, this would never happen to me. I'm so much smarter and da, 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 da. This is unbelievable. But I do feel like there is a brain mechanism that flips. And then once it does, you wind up in the backseat of a Mercedes handing over $50,000 in cash in a shoebox to someone you don't know.
On which note, I think that's it for us this week. Many thanks to Patrick for being here in DC. Many thanks to Jared Downing for producing the show from New York. Many thanks to Cheyna Roth for being our fairy godmother and keeping us all on track. I will be back on Tuesday with Carrie Sun, who has written a memoir called Private Equity, all about her time working at a hedge fund in New York.
So good.
Emily loved it.
Such a good book.
I loved it. You should go out and buy it. So that's coming out on Tuesday. And then after that, we'll be back the following Saturday and every Saturday thereafter with a regular Slate Money.